Welcome to Think Money with Benny. Here on the channel, we talk about investing in the stock market to produce passive income. In this video, I'm going to show you how to sell a cash covered put on Fidelity. I'm also going to discuss my thought process behind this strategy and how I used it with Facebook stock. Before we begin, I want to thank everyone supporting the channel. We're at over 2,500 subscribers. The next milestone is 5K. So if you're new here and enjoy the content, make sure you subscribe and join the Think Money team. Speaking of milestones, the portfolio is now sitting at 80K, almost at the six-figure goal. It's crazy to think how I started this portfolio with only $100 last year. I had so many questions and doubts about the stock market, but this is simply a result of working hard towards our goals. If you enjoy researching, studying the companies you love, and you're putting in the effort to learn, then go ahead and smash that like button. In my previous video, I showed you how to place a covered call on Fidelity, and I went over my trade using that strategy. The link to that video will be posted up above or down in the description. Today we're talking about selling cash covered puts. This is how you would place your order on Fidelity. Let's get through this quickly. So once you're on fidelity.com, you're going to search for the stock that you want to sell a cash covered put on. Then you're going to go to options. On this page, you're going to select puts under strategy. Let's select 20 to see a variety of strikes and contracts. Then let's assume we only want to see contracts for August 14th. We're going to deselect the dates that we do not want to see. Press apply. Then on this box, we're going to select the strike price. So let's assume we want to sell a cash covered put at the strike price of 240. Then we're going to go under bid and click right here. On this box, we want to make sure that the information is correct. The action is sell to open. Let's insert 1 to sell one contract. August 14 is the expiration date at the strike price of 240. We're going to make sure our limit is correct. That will be the premium that we will collect once we sell our cash covered put. Once everything looks good, we just preview the order and submit it. And that is how you sell a cash covered put on Fidelity. Quick disclaimer, I'm no expert in options trading and you should always do your own research. I'm simply sharing my investing journey here on YouTube for entertainment only. If you're experienced with options trading, let me know down in the comments if you have any advice when it comes to cash covered puts. I realize that trading options isn't ideal for beginners. These are trading strategies you can use to bring in more income once you gain the knowledge and confidence to use them properly. It's important to build a solid foundation in your portfolio first before reaching this level of trading. However, it's a good idea to see what other investors are doing and see what's bringing them success. That way, over time, you can implement these strategies whenever you're ready. Now, I want to go over the strategy of selling cash covered puts and the thoughts behind my trade. The first thing you'll need is the cash amount of 100 shares of a stock. 100 shares equals to one contract that you're able to sell. Once you sell your cash covered put, you instantly get cash deposited into your account. This is known as collecting premium. So there's a few things you have to think about here. Whichever company you choose, you have to accept the possibility of buying 100 shares of that stock at the strike price you select. The probability of that happening depends on your strike price. Let's take a look at the cash covered put that I sold last week as an example. I went through my watch list and decided Facebook is a company I'd like to own at the price of $215. For me to place this trade, I had to have $21,500 in cash in my account. That serves as collateral in case my put option gets assigned. I sold my covered put on July 29, one day before Facebook earnings, when the price of the stock was $230. The expiration date I chose was August 14, and I collected $389 in premium. My intention was selling this put far out of the money so it can expire worthless. Being that Facebook reported earnings the very next day and their stock price shot up to $250, I was able to close out the position sooner than expected. I bought back the option and netted a total of $359 in premium. So what were the possible outcomes from this trade? Number one, I make money collecting the premium if the stock price doesn't go down to 215 by August 14. Number 2, if Facebook goes down to 215 or less by August 14, I collect the premium and now I'm obligated to purchase 100 shares of Facebook at 215. However, this scenario was unlikely to happen in my opinion. Or number 3, best case scenario, Facebook stock shoots up early in the trade and I can get out of the position quickly. This means I don't have to wait until August 14 for the contract to expire. I then get back my collateral and redo the process all over again, if I choose to. This is exactly what happened in my case. So in the end, by selling cash covered puts, you let the buyer take on all the risk. As long as you do this with a stock that you don't mind owning, you can repeat this process to keep collecting extra income. Selling cash covered puts and covered calls are pretty conservative in my opinion, if you know exactly what you're doing. I know I'm only giving a brief overview of selling cash covered puts, but I'd recommend you to put in the effort to learn more about this strategy. Our question of the day, it comes from Nick Coles. By the way guys, go check out Nick's channel. He has a great portfolio and he breaks down company financials in a very understandable way. He asked, when purchasing a stock for income, do you look for dividend growth or do you look at the current dividend yield and why? Thanks for the question, Nick. Anytime there's dividend growth in a company, it's always a plus. But buying a company just for the dividend yield is never a good idea. I believe in buying dividend companies who put out products that you love. Which companies are producing the products that you need in your everyday life? That's where I would concentrate when picking dividend stocks. If you have a question you'd like me to answer, just comment down below and I'll try to answer it in my next video. All you content creators out there, that's your chance at free promo, so don't slack. I hope you got value from watching this video. If you did, go ahead and smash that like button. Subscribe if you haven't already, and I will see you in the next one. Peace.